When the Lippo Group first began to engage the World Economic Forum about 30 years ago, the size of the global economy was about $27 trillion, and about 15% of that came from the developing markets. 30 years later, that 27 trillion has grown to be about 70 trillion, and about half of that is coming from the developing markets. So over the last 30 years, we have really seen an unprecedented period of prosperity and growth, not only in the whole world, but also particularly in the emerging markets. Despite all this great progress, there is somehow a sense that this is not enough. There is somehow an expectation, perhaps a justifiable expectation, that this is incomplete, and that not enough people have access to healthcare, not enough people have the right education, not enough people have the skills to be productive in life. So it is this challenge really that is really exciting about emerging markets. And it is also this sense of urgency that provides the context and the reason for why we as a family, but also Lippo as a company, are in business. We hope that through our healthcare and our hospitals, we're able to bring global quality healthcare to more Indonesians. We hope that through the schools and the universities that we build, we can empower a new generation of Indonesians with the right mindset and the skills to be productive in life and to live a meaningful life. We're very fortunate that Indonesia has a group of people, of government leaders, who are truly unique and have a combination of bureaucratic professionalism, but also private sector entrepreneurialism. We're excited that, and we're hopeful that working together with the government and the private sector, we're able to make our small contribution to the future of Indonesia.
Good day, everyone. I'm Ron Insana. Welcome to the Lippo Davos Lunch Dialogue. We're here at the World Economic Forum's 2014 annual meeting. And today we're sitting down to talk about whether or not emerging markets are prepared for further Fed tapering and other events around the world that could affect their outlook in the days and weeks to come. Joining me now to discuss that is Jean-Claude Trichet, former head of the European Central Bank. Also, Minister Gita, who is the Trade Minister for Indonesia. Minister Mahendra, who is also here as well. He oversees foreign direct investment and investment in Indonesia itself, and Jim O'Neill, former chairman of Goldman Sachs Asset Management, who's been focusing on emerging markets for quite a long time. I thank you all for being with us. And Mr. Trichet, let me please start with you. For at least a few months, it seems that developed countries have gotten past the worst of the crisis, and yet there's still a certain sense of fragility to the system in this post-crisis world. Are we in a place yet, as the Fed begins to taper its policies, as the Bank of England does the same, that economies can now stand on their own, or are we not ready quite yet?
I think that you're absolutely right. The US is benefiting from a recovery which is absolutely obvious, even if the job problem remains an important one. In Europe, we are close to the end of the adjustment period for a number of countries that had been under threat. And of course, Japan is picking up again in a very, very clear way. So I would say still, of course, the interest rates are at zero level, and they remained at zero level for the last 5 years. The unconventional measures, even if they start being tapered in some countries, including in the US, are still very monumental. And in a way, there is an element of artificiality which has to be fully taken into account. So I would say what is being done is good. It is very good if all sectors, public and private, are really doing the job to make them much healthy and much sustainable in the long run. The process is going on. It's not achieved by far, and we have a lot of hard work to do. No time for complacency, in my opinion, in any advanced economy, and particularly, certainly no time for complacency in Europe.
And then, Minister Gita, with respect to emerging markets, which this year were supposed to take over and drive economic growth as the developed economies settled in to a more stable trajectory, yet in the first part of 2014, we're seeing a great number of disruptions. They can be either political or economic disruptions that are taking place. So what seems to be going on that has suddenly gripped emerging markets?
With regards to the emerging markets, I wouldn't consider them diverging. from how we would be behaving in the past. I still see emerging markets being able to benefit from what I have seen and what I'm seeing from a global economic recovery standpoint. Just to give you a bit of a flavor, if we looked at the Indonesia trade standpoint, the export of non-oil and gas, from a volume standpoint, it actually went up by 33%. Vis-a-vis the year before. And the 33% is actually a higher percentage compared to the percentage of increase in 2011, which was the Hay year. Now, I think this is highly attributable to what we're seeing in terms of the economic recovery in the US, in Japan, and in Europe, to whatever extent it may be. And we're seeing China, India, and some of the other large developing countries, I think, being a lot more optimistic about the economic recovery that's happening in some places. Now, we're not seeing oil price picking up like we would have seen. We're not seeing gold prices behaving unstably as we would have seen. So I would put some belief and premium into the fact that there's stability in some sectors. I think there needs to be a bit of a pickup in perhaps inflation or interest rate, and that I think would be good in the mid and long term.
You know, I think part of what is going on is that people just don't understand the world still. You know, some of the nonsense I've read about China is quite extraordinary. China slowing down to this, this dramatic slowdown and the obsession of focus about its debt problem. Probably hardly anybody in this room realizes that at the end of last year, China's economy has now become $9.2 trillion. The end of 2008, it was $4.5 trillion. China's GDP has doubled in 5 years. 7.7% growth is like creating the equivalent of to the world of if the US were growing by 4. So when people sort of have this blanket thing about emerging markets, which in essence has been flying around ever since the Fed first started making noises about tapering in May, it's kind of ridiculous. But it's the sort of simplistic, I guess we all have to live with little boxes, and that's the way it is. So that's my first point. Second one, however, for many of these countries that go under that label, the last decade has been kind of pretty easy to show that you're good, because you've had the Fed being extraordinarily generous, and at times many other central banks too, and for many of them, they were big beneficiaries of the old China, Indonesia being one of them. Many others too. In my judgment, what's going on now is not only a lot of complexities involving some rebalancing within the developed world, but between them. But I'm a strong believer that we are going into a new China. And the winners and losers of the new China are probably going to be very different than the winners and losers of the old one. Certain so-called emerging markets that have got big current account deficits that were benefiting from large commodity price rises have got some challenges. And in the case specifically of Turkey, you happen to invite yourself to have some ridiculous political mess too. Surprise, surprise, you're going to have a couple of issues.
And Minister Mahendra, with respect to that, and Jim, who is known for having created the acronym BRIC, Brazil, Russia, India, and China, and I'll let him expound upon this a little bit further, is now talking about Mint. You happen to be the I in the Mint as one of the positive countries in emerging markets. How, though, do you separate yourself from other countries in terms of positioning your nation as one that is, in fact, as we discussed maybe yesterday, worthy of foreign direct investment?
I have a mixed feeling about this tapering off. It's not just the tapering off, but the whole episode of unconventional monetary policy, politically correct term of excessive liquidity policy, which basically just create difficulties in the emerging economies and developing world, because then we have to live with the impact. But on the other hand, this tapering off, in a way, have been able to uncover individual emerging economies structural problems. And this is a good thing as a blessing in disguise, not as the main purpose in itself. In a way that individual country has to recognize their structural problems and deal with it. The best time to reform is when you have difficulties. And I think this is when all emerging economies, including Indonesia, is being tested. The issue of tapering off, that was an alarm call for everybody in Indonesia. Looking at the issues domestically, rather than just blaming the Fed or the tapering off. And then we focus on the issue of current account deficit, which is structural. We need to address that. And then we look at the issue of infrastructure situation that is, well, by far is far from satisfactory. And then the issue of too much dependent on oil import and also a subsidy on oil. So these are all structural problems that Indonesia need to face and to get back to where it belongs, which is, again, the attention of investors. We can't wait for the tapering off to really taking place, and the sooner the better.
Jim, it seems like there's a preoccupation, obviously, with tapering.
It's all people ever talk about, tapering. There's more to life than tapering. The world kind of wants the US to be different than it was, because that's why we had the mess that we've all been struggling with since 08. That's why 08 happened. US didn't save anything. It borrowed everybody else's savings to finance probably inappropriate energy policies as well as lots of other things. So maybe in hindsight, parts of the crisis were necessary to sort of cleanse aspects of the world. So I think it's really good that's what's going on in the US, and I am quite bullish about the scale of the change that's going on, which I still don't think people truly kind of realise. If Indonesia's story was just because of the old US and the old China, Indonesia's going to have a tough time. But I know Indonesia's trying hard to be a different kind of place and to deal with some of these hangovers from that period. There are a number of countries in the so-called emerging world that have perhaps become a bit lazy and are vulnerable to these things.
With respect to old and new, is there an old Europe and new Europe now? You've gone through not only our crisis, but then the sovereign debt crisis subsequent to that. Is the same type of purging and the same type of structural reform going on meaningfully enough that Europe can also grow its way out of this problem?
I think you certainly have an entirely new Europe as regards the new governance. But Europe is a historical process. Europe is always in the making. And in my understanding, the mistake which was made by a number of observers was to think that Europe would not be resilient at all. Europe has been fantastically resilient. I give you only two examples. The euro has never been into question on the exchange market. When everybody, and the title in the headlines was, the euro, they do that to save the euro is about to collapse. Never a sign of, since Lehman Brothers, nothing on the euro. And as regards the euro area, again, it was true that there was immediate and grave threat of change, dramatic change in the euro area composition, with some countries leaving perhaps. But all taken into account, the 15 that were in the euro area at the Lehman Brothers moment remain in the euro area, and 3 new countries entered since Lehman. And we are 18 now and not 15. And it doesn't mean that the Europeans should be complacent.
Minister Gita, with respect to the rather optimistic outlook we hear, but what's happened in the last several days smacks me as at least being a warning sign that we could see some sort of imbalance emerge that might destabilize temporarily. Is there anything that really captures your attention as being worthy of note?
I think we've just got to make sure that this liquidity that's so rampant doesn't dry up. too quickly, right? Because if it does, then I think it's going to be not only net bad for us, but for the U.S. and the other developed markets. I think there's a recognition by the U.S. that the tempo of adjustment has to be at the right tempo. And I think a strong U.S. is good for the rest of the world, but a strong developing market or markets would be good for the U.S. I'm not, of the belief that the last few weeks' worth of symptoms that we're seeing are indicative of, a different scenario. I think, I usually see, gold prices, oil prices as indicators of whether or not things are going to go more stably or less stably. And we're not seeing any of that. And we're seeing a pickup in exports of non-oil and gas products from countries like Indonesia and other large developing countries. Now, for the next few years, our largest trading partners are going to be China, Japan, and India. Not the US, not the European Union. So we've just got to make sure that China and Japan and the other large Asian countries would grow, in a robust manner. And I think they have a chance at doing that. What Indonesia needs to do is to get on a world stage in a context of being a global brand or having a global brand. And we need to have a global brand in terms of being able to manufacture something. And I think the simplest illustration is our ability or needed ability to produce or manufacture a hand phone, which is easily going to be consumed by 250 million Indonesians. Then that will set the tempo for Indonesia to be on a global stage in a different way. But until then, I think we're going to be relying a lot, on our trade, on some of our big neighboring countries. And I think China is likely to be or stay as a robust economy for a few years from now.
Mr. Mahendra, the question of hot money coming into countries like Indonesia, we saw what that did in 1997. We saw it again in other countries in recent iterations. Are you concerned that the surplus liquidity that flows into countries like yours can be easily taken back and create some disruptions, even as you make the structural reforms that are healthy for your economy?
Yes, of course. I mean, Indonesia could not be isolated from what happened in other parts of the world, especially if the policy comes from the US. But I think it's important to look at it in a better perspective. Yes, we have to deal with it, and that's why I welcome the tight monetary policy done by the central bank. And I think that has in a bit reduced the potential capital outflow as a sudden risk. So I think as long as we have been able to address as much as possible the potential impact of the excessive liquidity from the global market, then that's the most we can do. And people, investors, portfolio, especially direct investors, are looking at these signals, whether we have been responding properly and strongly, and with the firm belief that reforms at the end will set the tone. It's not just the global economic situation or excessive liquidity. If we can fulfill that commitment and then consistently delivering in that, I think we are fine. We had a record high increase of 2013 year of 26% year on year, unprecedented, divided into 39% increase of domestic direct investment and 22% increase of FDI. Indonesia is enjoying, especially in my portfolio, investment in the direct investment is a great story, but I just warn you, you haven't seen the best yet.
If I was in the position of a nation that had been loved by people and now was not perhaps being quite so loved, or at risk of being very unloved because the Fed might start doing the dreaded, more aggressive tapering, I would want to make sure I'm really focused on getting some basic things improved in the eyes of investors, and in some ways try to rely even more on FDI than what might be quite fickle portfolio flows. That's part of the mint thing. Mexico, Indonesia, Nigeria, and Turkey, and I'm not transitioning from BRICS to them. They just happen to be 4 of the largest populated so-called emerging countries after the BRICS, and they all have got fantastic demographics. Fantastic. These guys, along with Nigeria, the absolute best. So if they can harness that with some improvements on productivity and finding some things to show the world, they're not going to be needing to sitting around worrying about Fed tapering. They can't control that, so you can't worry about it. What they've got to do is focus on sorting themselves out. And I kept, in fact, more the week went on, I kept asking people, I think I asked John, where is Indonesia's Samsung? But it's got to concentrate on that and things to boost the productivity. Because it can't really do much about the stuff going on in the rest of the world other than sit around worrying about them. And I don't think that would be the right thing to do. And in some ways, even though I don't personally expect the Fed to be that aggressive, as these two have both said in a way, and Jean-Claude, that it sorts out the weak from the strong. And it's going to come at some stage. So you want to make sure you're doing the right thing so you're not so vulnerable.